Hi, I'm Kylie Matu. Welcome to Wealthy Millionaire. Today we're going to talk about 5 essential tricks for finding stock leads. But first, a disclaimer. I'm not an accountant or a stockbroker. These are for educational purposes only. So always be sure to consult with a professional before making any financial decisions. So number 1, adopt a good investing psychology. Much of what makes a good investor goes against the most basic human instincts. Controlling your urges and impulses will allow you to make sound investing decisions. The primary impulses that lead to poor investment decisions are fear and greed. No matter how sophisticated or advanced your investing strategy is that you're using, it's not useful if you allow your emotions to override your logic. Good investing temperament means admitting when you're wrong, cutting losses, allowing profits to grow, and carefully managing your risk. On Wall Street, there's a saying, bulls make money, bears make money, and pigs get slaughtered. In other words, people who let greed influence their investment decisions will take unsustainable risks, allow losses to grow, and take profits early. Most importantly, a level head will give you the clarity of mind to carefully research, to execute, and to manage your investments. Number 2, know what you want and how to find it. There's much more to stock investing than what appears on the surface level. Many have a general idea of making a profit with much consideration for the details or available options. Knowing what you're looking for is essential. For example, an investor searching for high monthly dividends will research the highest performing dividend stocks, their max drawdown rates, the fundamentals beneath the companies, and how they compare to other stocks in order to find the best dividend stocks to buy right now. Additionally, an investor seeking opportunities for high performance may seek out managed products such as exchange-traded funds, ETFs, and closed-end funds, CEFs. Understanding the different types of products available will give you more choices and opportunities to make the most of your capital. Many retail investors look for the easy way out without focused goals. This means taking random tips, overlooking most of the market, taking bad risks, and being unaware of special investment products in the stock market. With a patient investing mindset, you can develop carefully researched goals and extract the maximum possible value from the stock market. Number 3, learn the fundamentals of value investing. Value investing is the bread and butter of making long-term gains in the stock market. It may not be as exciting as buying into popular trends, but anything worth doing requires hard work. The basic principle of value investing is choosing undervalued stocks. You should determine what stocks are undervalued right now by researching their fundamentals. The fundamentals are the core indicators of a company's health and future performance. Stocks often overreact to news. Value investing means ignoring trends, researching financials, and finding quality long-term companies. Many famous investors like Warren Buffett have used the exact strategy to break world records in investing success. Some metrics for gauging a company's health include finding low price-to-book ratios, undervalued price-to-earning ratios, and substantial free cash flows. These all indicate a stock that is undervalued and projected to grow in the long term. These strategies allow you to calculate the real price of a stock, and if it's greater than the listed price, owning the stock will lead to a profit. Of course, there is a margin of error to consider, but it can be negligible if the difference is substantial enough. There is much more to value investing than we can cover here. An excellent resource for understanding the art is the book, The Intelligent Investor by Benjamin Graham. This book is highly praised by the most successful investors in the world. Number 4, managing market risk today and tomorrow. It may go against natural impulses when seeking gains in the market, but it's actually more important to consider what you can lose than what you can potentially gain. The principle is called risk management, and it's what makes the difference between a successful and a reckless investor. The most successful investors buy stocks because they expect high rewards, usually with share price appreciation or dividends, over the years or decades. That means you can take your time in buying too. Let's take a look at 3 buying strategies that can reduce your exposure to price volatility. First, we have dollar cost average. This means investing a set amount of money at a regular intervals such as weekly, bi-weekly, or even monthly. This allows you to buy when there may be dips in the market. When dealing with a firm or a broker, they allow for their clients to have an automated investing schedule. Buy in thirds. Similar to dollar cost averaging, buying in thirds helps you avoid the morale-crushing experience of bumpy results right out of the gate. Divide the amount you want to invest by 3, and then, as the name implies, pick 3 separate points to buy shares. These can be put at regular intervals, so like monthly, quarterly, or based on performance or company events. For an example, you might buy shares before a product is released and put the next third of your money into play if it hits. Another option is to buy the basket. If you can't decide which of the companies in a particular industry will be the long-term winner, buy them all. Buying a basket of stocks takes the pressure off of picking the one. So this is a strategy that will also help you identify which company is the one so you can double down on your position if desired. Then there's good old risk management, which means knowing exactly how much that you're willing to lose on your investments, including when to get out of the market. As a rule of thumb, you don't want to risk more than 1% or 2% on each investment. One very effective tool for risk management is stop loss. This is a tool offered by brokers that automatically close your position when the price reaches a predetermined level of loss. So setting a stop loss at 1% or 2% will allow you to make several bad trades without making a huge dent in your portfolio. Additionally, it will enable you to create many opportunities from a single good trade. Something you must understand is that you will make mistakes. Every investor makes bad decisions time and time again, but good risk management means that you'll still come out on top. For example, a lousy investor will hold on to a losing stock and lose 10 or 20% of their portfolio in hopes of it turning around. A good investor will set their ego aside, take a 1 or 2% loss on the same stock, and easily make it up with a diversified portfolio. Number 5, educate yourself on different asset classes. Many retail investors are very hasty to enter the market and start making profits. Nothing stops anyone from opening a retail account and buying stocks without any prior consideration or knowledge. If you take the time to educate yourself on different asset classes, you'll have a distinct advantage and make greater profits by placing your money into superior assets. For example, a hasty investor may simply pick a list of popular stocks right off the bat, trying to beat the market without much preparation or foresight. This is risky as the investor has no knowledge of the company's fundamentals or projected future growth. On the other hand, an informed investor may take the time to research stock equity funds that are already beating the market by wide margins and paying out dividends in a monthly income. This investor will make the most of the sophisticated teams of professionals who are completely focused on managing capital in the stock market. The more time you put into learning about the stock market, the different types of investment products, and the fundamentals of the companies that drive them, the greater your chances of success. A successful investor has confidence in the profitable allocation of their capital. Now let's take a look at some frequently asked questions. How do I open a brokerage account? While there are many brokerages out there to choose from, compare the costs and incentives offered by each brokerage and services provided. Once you have decided on the brokerage firm right for you, fill out a new account application and fund the account. Now you're ready to invest. Another question, what is S&P 500? Well, the S&P 500, also known as the Standard & Poor's 500, is a stock index that is made up of the 500 largest companies in the U.S. It is generally considered the best indicator of how U.S. stocks are performing overall. What exactly is the Dow Jones? The Dow Jones Industrial Average is a widely watched benchmark index in the U.S. for blue chip stocks. The Dow Jones is a price-weighted index that tracks 30 large publicly owned companies trading on the New York Stock Exchange, the NYSE, and the NASDAQ. What is a trading plan? When choosing stocks, it is sound advice to write down your goals, which should be specific, measurable, and attainable. Deciding on your trading style will help reach your goals as it will determine the different time frames that you should trade, the holding period, and level of trading activity. Example, position trading, swing trading, day trading, or even scalping. Another question, what is a market screener? A market screener is a tool used to look for stocks. You can use a market screener to easily compare stocks against each other. And lastly, what is risk management? Risk management is the strategy that is put into place when managing your stock portfolio to keep losses under control and to maintain a good risk to reward ratio. I hope you enjoyed this session on the 5 essential tricks for finding stock leads. I'm Kylie Matu. Thank you for watching Wealthy Millionaire. And remember, the more you save, the more you earn.